Hey, good morning, everybody. It's Hammer. Today is Monday, October 21st, 2024. I, of course, am with Originator Success here with your daily mortgage rate update, the only place on the web where you guys get to join me live each and every weekday morning, 9:30 a.m. Eastern Time to talk about rates and pricing. Broadcasted to you on Facebook and on YouTube. You can catch us either way. And if you don't catch us live, you can go ahead and watch us anytime during the day on the replay. Anytime it's convenient to you, just go to our Facebook business page or my personal feed or our YouTube channel and watch the replay. If you do watch the replay, don't forget to give me a hashtag replay in the comments. Let me know that you were here. Let Facebook and YouTube know that you were here. If you're here live, like Dan Crowley, Tom Dedmore, and Tiana Rogers, make sure you say good morning and let us know that you're here. Don't forget to smash that like button, tag an LO friend, share us in a group. Remember, if you'd like to sign up for our free email lock advice, you could do that. It's an email to your inbox each and every weekday morning. You can use this cool QR code, or you can go to www.ratelockadvice.com. If you'd like to get our text alerts, we send out a morning alert, an afternoon wrap up, and then alerts anytime that reprice risk is out there. Help you to protect your pipeline. Whopping $7 a month. You can check us out at ratetextalerts.com. If you would like a reminder that I'm going live, you can go ahead and sign up for that at hmmr.io/reminder. It's just a free text message, just to let you know that I am here each morning if you'd like to make it a set it and forget it quick link kind of thing. And last but not least, although I love talking about rates and pricing each and every weekday morning, check us out at originatorssuccess.com. It's one small piece of what we do. Our elite program helps you to actually get found on Google and social media. We help you to build out your online profiles. We help you to generate reviews. We help you to stay in front of real estate agents, past clients, prospects. Today we'll be doing the weekly rate forecast, which will be very important with it being so ugly as it is, as I'm going to tell you in a minute. So check us all out at all those good places. Let's go ahead and say hello to our live folks here this morning. If you're here this morning, say good morning. Let me know that you were here. And we'll go ahead and say hi to each and every one of you. Mr. Dan Crowley, hope all is well as in your world. Tom Dedmore, good morning, sir. Tiana Rogers, great to have you here. Clayton Atienza, a name I'm not too familiar with. Welcome, Clayton. Glad to have you here. Amy Blauser, good to see you. Colin Jordan, welcome, sir. Megan Lindberg, great to have you. Amanda Lund, great to see you. EJ McDonald, that's a new name. Welcome, EJ. James Mahan, great to have you here from the Nexa Nation. Rob Stewart, great to see you, sir, and appreciate you. Yasmin Martin, good morning, my friend. You got to rock some Originator Success swag for me, Yasmin. Show us some pictures. Mike Morano, good morning, sir. Mike says, happy Monday. Financial Times, Yahoo are all talking about rates going back to the sevens. I'll tell you, this morning we're going to talk about that, Mike, for shores and for reals. Michael Love, good morning. Ron Siegel, good morning, sir. Ron, today is not National Pumpkin Cheesecake Day. Today is National Cry in Your Beer Day. I have changed it. It is Cry in Your Beer Day because we will all be crying in our beers today and maybe gorging ourselves with National Pumpkin Cheesecake. National Pumpkin Cheesecake. But good to see you, Ron. I haven't seen you in a while. Thomas Sloan, great to have you here. Karen Cabrera, Venkat Malapati, good morning, sir. Allison Foy, Mallory Fotiadas, good morning. Sean Segaloff said morning. I'm not saying good. I'm with you, Sean. It is an ugly way to start the day, unfortunately. Jordan Ross, great to see you here. Kenny Rivard, and for those of you, Ron Siegel tagging somebody, thank you, Mr. Ron Reza Uera. Good morning, Mark Clark, Jerry Avila. Great to have you here. All right, y'all. So let's go ahead and dive in. Let's get into the meat and the potatoes of it all. And we just got to rip off the Band-Aid, basically. So I'm going to go ahead and let me bring the screens up. We'll go through what's going on this morning. Lock float advice is down at the bottom. You will see that mortgage-backed securities are down 23 basis points to start the day. This is bad for so many different reasons. I want to try to stay focused, though. So I'm going to stay to the kind of what's here. The quote of the day today, by the way, that I used in my written email is: the pessimist complains about the wind, the optimist expects it to change, the realist adjusts the sails. Unfortunately, this is a brutally real quote for us today from Mr. William Arthur Ward. The pessimist complains about the wind, the optimist expects it to change, the realists adjust the sails. We take a look at where we're at this morning. We have to be realists and we have to adjust our sails. There has been just a lot of ugliness going on here. So a quick recap on Friday. Let me make this a little bit smaller so that it will. Well, oh, wow, that was weird. Okay, hold on a minute. We don't want it to be that much smaller. Let me grab that corner, move this. Okay. All right. So I'm going to refresh this so we can zoom in on it. But yesterday, on Friday, I say yesterday, but Friday was a calm day and it brought some hope. As we were heading into Friday, you could see right here, see this green candlestick right here? This one right here, this green candlestick, we were right on the 100-day moving average. You could see that right here. This was a support level for mortgage bonds. What we're looking at right here are mortgage-backed securities. We're looking at mortgage bonds. And when we take a look here, when we look at this level, you could see that we had shown some stability. Things had, kind of gotten like calm. We had lost ground. We had that weak jobs data, and then things kind of settled in, which is what we were expecting to see. However, on Thursday, we lost a lot of ground, and there wasn't a lot of reason for it. We could blame retail sales for some of that, but I mean, overall, there just wasn't a lot of reason to lose this much ground. But Thursday really saw things turn around. Friday, we were like, okay, that brought us to the technical support here, and let's float into next week and see if we get our bounce. We were looking for a bounce this morning. This morning, I was looking forward to telling you how mortgage-backed securities were up 10 or 12 basis points and rate sheets would be slightly better than on Friday. Instead, things have gotten brutally, brutally ugly. And there's quite a few things that are happening here. So first things first, rate sheets today will be worse. And this morning is an absolute cold shower to rates, with both the 10-year and mortgage bonds reaching new worst levels. And when I say worst levels, I mean for this current trend. Like if you look at the 10-year here, this is the 10-year treasury yield. Right now, the 10-year treasury yield, 4.13. Okay, we've been at 4.13 before. We've been higher than that out here back in July, but it has been the last time we were at 4.13 was here in July. And as we're going into August, we have not seen it this ugly since August. Now you go through August, September, and here we are into October. And all of a sudden, remember, this is when we had the expectation, hey, the Fed is going to cut rates. That's when we saw the 10-year treasury yield dip down, these green candlesticks that you see here, that we went down, down, down. Now, remember, when I look at the 10-year treasury yield here, the lower the yield, the better that is for mortgage rates. When the yield goes higher, that's worse for mortgage rates. So we've seen that yield drop. We've seen it continue to move lower. And then back here, we jumped up. And here's that worst day, Friday, October 4th. We had that really crazy jobs data. And we figured, okay, this is about as bad as it'll get. There were reasons to believe that we had some technical support there. Instead, it had continued to move up and break. And we hit the highest level. We closed at 4.10. And then we improved. And then we got worse. Again, here was that Thursday. It got worse. And Friday, it improved again. And then today, we are worse. So this really puts us into, oh, that's not the lock advice that I want there. Hold on. Why is that? Yeah, it is. Okay. Oh, it's funny. It's not showing. It didn't update. Okay. Look at the lock advice down at the bottom, by the way, that it didn't update. It was pulling the old one. The lock advice is actually lock, and cautiously float. So taking a look here at the 10-year treasury yield, rate sheets today are going to be worse. When we look at reprice risk, it's moderate. We could see things continue to get worse from here. There's no expectation that we would expect that they're going to rebound. We can see this 10-year treasury yield push up and test this 200-day moving average up here at 4.17. That's very realistic that could happen. It's already broken past 4.12, which was one of the Fibonacci levels. So we're up at 4.17 is where this could get. As far as mortgage-backed securities, they have broken through this 100-day moving average, And I mean, significantly. We're not just sniffing slightly lower here. Like when you saw right here when we broke this 25-day moving average, see how it just goes a little bit below it, a little bit below it. And it's kind of flirting there. We have significantly busted below. When you take a look this morning, I don't know if I think this is probably just what they call trade chatter. I would ignore this little blip of line that was in there for the day, right? But looking at this 2-day, this I don't think that this is legit. I think this is probably chatter. I would just take that out. We dropped, and with domestic trading have gotten absolutely no help. Normally when we see a lot of weakness in overnight trading, we look for a bounce in domestic trading. We have gotten none of that. All right. So bonds have nothing happening to provide any hope of improvement, and we could see things get worse today. There's nothing going on as far as that's not what I wanted. Let me make this a little smaller so we can get there it is. So taking a look here at the economic calendar for today, there's nothing going on. We got some Fed members speaking, otherwise nothing today. Tomorrow, nothing going on as well. We don't have anything actually happening until later in the week. You could argue that the beige book on Wednesday might get some attention, but I really don't think it will. We've got PMI data coming out on Thursday and consumer sentiment coming out on Friday. But even if those show any kind of strength, it's only going to make things worse, not better. So this is just a really, really ugly move lower this morning. And it's something that is, I mean, it has definitely changed our outlook for how we expect things. Now, one of the things that I want to kind of show y'all though, and that we want to note here is when we take a look at the Fed rate cuts, that has not changed at all. So speculation of Fed rate cuts has not changed. Markets are pricing in, and I'm going to refresh this just to see if anything changes between earlier this morning and now. Markets are pricing in a 90% expectation that the Fed's going to cut rates at the November meeting. Markets have not given that up at all. And if we take a look here at the December Fed meeting, that is exactly where it's been as well. 75% expectation that we would see 2 rate cuts, bringing us to 4.25. So we'd see a quarter point cut in November, a quarter point in December. About a 25% expectation that the Fed may only cut in November and take a pause in December because of the strength of the data that we're getting. And I think this is actually going to improve, to move higher. I think things are going to get worse. Tim said, why cautiously float? Shouldn't it all be lock? So Tim, let me, that's a great question. And then I'll come to what you had said, Siegel. So let me go ahead and I'm going to send out my written email lock advice in a little bit. I can't move it over. Hold on a second. Let me make it like this and pull this over. Okay. So here's what I said for the 30 plus days. Even these loans have much less optimism than we had just a few weeks ago. And if risk averse, have to consider locking at this point. After all the action to come in November, we could see rates that are a half a point or more higher than today. That's actually a reality at this point. Now, it's very difficult for me to stomach telling you to lock anything that's closing in 30 plus days because we have November 1st jobs data. We've got November 5th election. We've got November 7th Fed meeting. And then when is the CPI data? Hold on. Let's Google that. So CPI inflation dates. So the releases will be November 13th is the next release. So you guys, I'm sorry, it's not pulling it up on the. There you go. So November 13th is the next one. So, I mean, even that, though, I don't know if that's necessarily going to be a big deal, right, with what we're looking at. But the reason that cautiously floating anything 30 plus days, because we could see a rebound, but don't hesitate. Cautiously means don't hesitate to lock it. If the consumer likes where they're at and you want to lock it, lock it. We absolutely, this is such a huge turnaround. And again, y'all, I know that you guys don't think I know the future and we're realistic about this, but let's just recap for the 53rd time. And I do this in the written lock advice a little bit this morning. Let me just pull this over. Let's just recap one more time. I said, my friends, I can only say I'm sorry. My forecasts and many others from a month ago haven't aged well. When the outlook was that rates would make slow moves lower as the economy and labor market weakened while we welcomed Fed rate cuts to bring in a soft landing. That's where we were at as we were in September. When we look back in September and we look back at where mortgage bonds are, I got to refresh this so I can scroll. When we look back at where mortgage bonds are in September, right? Look at where we were right before that September Fed meeting. And I wasn't shaken up by that Fed meeting. Like when we looked, the Fed meeting was on the 18th, right? So we hit our best levels here with mortgage backed securities. This is up here in early September, right? Or mid September. This is like September 16th ish. And then we had the Fed meeting and things really they weren't really that bad. The Fed cut rates by 0.5 point instead of 1/4 point. We were a little bit off of the best levels, but we certainly weren't in trouble. It wasn't until after that things really, really, the Fed meeting was on September 18th. It was right here. We were at 101.41. The next day we were at 101.54. Then we were at 101.37 where we ended that week, and really didn't put us anywhere different from where we were right before that Fed meeting. But then after that, it looked like we were going to kind of see some stability, maybe a little bit worsening. We were riding it. And then boom, the jobs data came out and we just tanked. And then it looked like we get some more stability and boom. And things have really turned around here. It's been a big turnaround. And that's what, like what Ron is pointing out. Ron said the 10-year is sitting on Fibonacci 50% retracement resistance, 4.126. And so we're at 4.138 right now, though, Ron. So it's definitely above that. That I don't think that level is going to hold. The AMBase is sitting at the 23.6% Fibonacci support at 99.91. I don't put any credit on that holding at all today. I think that I know what you're saying, and he says hopefully these hold and we see a rebound. I don't think that the fundamentals, the market momentum is there for that. There's no reason to expect that traders are giving in on that. I think we're actually going to see bonds continue to worsen. I think it's just the momentum that we've seen. When you've got this, which we were looking for rebounds, we have not seen an actual firm rebound. If I put these on there, we've stabilized. We have not actually seen a rebound. This is our best chance was right here back on October 15th, 16th. We were starting to see that move up, but it couldn't hold. And then boom, tanked on the 17th. Here was the 18th. And then here we are today on the 21st. So it's definitely ugly. Mike says McDonald's stock rally will lift it all boats. Yeah. Maybe not enough. I don't think PCE data is going to matter at all, Ron. I don't think markets are going to even, I didn't even bother to pull it up as something that is even relevant because, but let's take a look and see PCE inflation dates. The personal consumption expenditure, the November 31st, as Ron pointed out, but I don't think it's going to matter at all. So again, I feel so bad to have been encouraging everybody to float through the where we were. But when we looked at what was going on with markets and we looked at expectation for the Fed rate cuts, and we looked at what was going on, the reality of what was going on in the labor market, the reality of what was going on in all these things, we were looking for a turnaround. Ron said in his Friday market update, he detailed how the numbers are all being manipulated, ADP, BLS, retail sales. How can we rebound when the numbers are all being fabricated? Post-election, when the adjustments come out, we'll see the rate cuts really drop. When you say really drop, you mean you'll see the rate cuts, you'll see more Fed rate cuts will increase, you mean? And I don't disagree. Lee Witt also says the same thing. He says doing the whatever they can to make the economy look good. And it's hard to argue that, y'all. I mean, the real world, when you get out there and talk to people, they're struggling. They're struggling hard. We've talked about how consumer resiliency isn't resiliency, it's consumer credit card debt. People are in more debt than ever. I did a video the other day about how PayPal and Concerto, which is a bank, they turned around and just immediately sent out an email and closed accounts that day. And it wasn't for me, it was for everybody. Now, and this was a business credit card that had a $25,000 limit that I was using on a regular basis. They just cut relationships. Barclay turned around and cut my credit limit from 25,000 to 5,000. Now they said it was because I wasn't using the card, but many of my friends said that they had similar experiences. Now, there were a couple of outliers like Discover that had increased limits for some people, but overall, the writing is on the wall that things are bad. And yet we've gotten reports that everything is good. And the way that markets are playing this, and stocks continue to hit record highs, they just rally and rally and rally and rally and rally. And, it's all part of the economy. It all drives the whole thing. So again, I'm flabbergasted. This makes forecasting very, very frustrating because we have certain things lined up that make sense on why things are going to be. It's like saying, okay, I'm going to take this yellow crayon, I'm going to take this blue crayon, we're going to mix them together and we're going to have green. And then you take yellow and blue and put them together and you come out with purple. And you're like, where the hell did that come from? That's kind of what it's been like trying to forecast rates in this last 30 days, because we just had that report, the jobs report, all this stuff, none of it makes sense. Ron Siegel said, darn hammer, why couldn't you anticipate all these fake numbers? We're looking at all-time highs. The seasonal adjustments are higher than at any time in the past decades. I agree. I mean, Ron's putting out all the legitimate. So again, I'm sitting here apologizing because I hate being wrong. Who doesn't, right? And people look to me and my judgment and advice and tell me how often I'm right. And then when you're drastically wrong and you're trying to figure out why, well, we've been beaten with the lying stick here. So hopefully Ron is correct. He says that rates will drop and the cuts will increase after the election, after all this stuff. Goldman Sachs is ending their credit card partnership with Apple. And who was the other one they just did a big one with too? Oh, there was another big company. I forgot. They were ending with one of the big names that it was like, wow, that they do all of their, I can't remember. So does anyone believe they did that because they see a strong economy? Exactly. Right. Exactly. So anyway, we are at 22 minutes, y'all. Thank you again for spending time with me today. The main summary here is buckle up. This is not what is supposed to happen, but as I put in the quote, we have to be realistic about what's happening. And this is, it's going to cause anxiety. It damages your psyche, but it's about getting out there and prospecting. Write the loans you can write right now. Encourage people to be buying houses while what this is going to do is help push home prices down a little bit. We're going to see that for a little bit. I know a lot of people, I sent out the link for the sales scripting webinar that I did last week. But in that one, we talked about one of the things in that one was about, people want to wait until after the election. The reality is you're not going to get them not to at this point. So Jerry said, doesn't the world know that Hammer dictates rates, right? Low rates for everybody, Jerry. Let's do it. But yeah, I wish. So anyway, my friends, thanks again for joining me. I'm so sorry to bring you bad news. I'm sorry to give you a bad outlook. Just trying to keep you updated and you can have some conversations with people on why things have turned, what has changed. But it's not good. It's not good. So, all right, my friends, I'm going to wrap it up. You guys have a fantastic day. I say that. I know it's hard to have a fantastic day when rate sheets this morning are going to just be, bloody and ugly. So, but try to have a good day. Try to keep your chin up. We'll get through this. And I think Ron is at least partly right when he says after the election, things will get better. I think we're going to go into the end of the year and things are going to start to improve. So it's going to be a good 2025, but not going to be the ending we wanted for 2024 is what it looks like. So, all right, my friends, we'll talk more.